what we're going to be looking at here is comparing debt versus equity financing for a return on assets and a return on equity. So a company has invested in assets here, and they can either do that by taking out debt here to purchase these assets, or they can issue common stock through shareholders' equity here to again buy those assets here. And with the assets, they're going to have a return on investment. So what this does is you're going to have a combination here. Companies are either they're going to be taking out debt here, and they're also going to be issuing common stock or shareholders' equity to buy these assets. Now, the logic that we're going to be using here is that we have this accounting equation on our balance sheet here, where assets equal the liabilities here plus shareholders' equity. So just follow through on that logic here. So what we're going to do is we're going to have two companies here that we're going to compare. Corporation A here is going to have greater long-term debt here versus Corporation B, which is going to have greater shareholders' equity. So what we're going to start with here is this the liabilities and shareholders' equity for both of these companies, Corp A and Corp B. And this is in millions of dollars here. So just going through this really quickly here, current liabilities, Corp A is going to have only $600,000 versus Corp B's $1,200,000 here. But this is where we come into the difference here, where Corp A is going to have long-term debt, and they're going to have an interest rate of 10% on that debt here. So they have a $2,400,000 here in long-term debt versus Corp B, which has got, for this example, is going to have zero here in long-term debt for comparison purposes here. And then when it comes down to the equity here, well, Corp A is going to have less equity here than Corp B. So for we'll throw it all into common stock here. Corp A has $4 million here in common stock equity here, and Corp B is going to have $5,800,000 here in common stock equity. And then when we get down to our retained earnings here, both are going to have the same here at $1,400,000. So our total debt plus shareholders equity, total everything up here, Corp A is going to be at $8,400,000 versus Corp B, same number, $8,400,000. The difference is that the Corp A here has that greater long-term debt, and Corp B here has a greater shareholders equity. Okay, and then again with our equation here, assets equals liabilities plus shareholders equity here, both of them have the same number of assets at $8,400,000. Balancing with our debt plus our shareholders equity here. Okay, now let's go and let's look at our net income here for both Corp A and Corp B. So our income before interest and taxes here, both have the same amount here, $2,400,000, same for each. Then the interest expense, well, Corp A has that long-term debt here at 10% here, and that equates to $240,000 here in interest expense here, where Corp B has zero interest expense, again for our example here. So the income after interest expense, Corp A is $2,160,000 versus Corp B here at $2,400,000. So Corp B here, our Corp A here is less income because of the interest expense. Now income taxes, we'll just say they're at 40% here, subtract out our income taxes for both of them here, and we're going to come up with our net income here for Corp A, $1,296,000 versus Corp B, $1,440,000. So you can see Corp B here has greater net income here because they don't have that interest expense here. They're financed more through equity here. Okay, so now let's go and look at our ratios here, and we're going to be doing a comparison here. And our comparisons again will be just between these two companies here, Corp A and Corp B here. And we'll start with the rate of return on assets, which is net income divided by the assets. So let's start with Corp B here. So they had net income here, $1,440,000. Total assets here is $8,400,000. So that equates here to 17.14% return on assets. Now Corp A, their net income here was $1,296,000 that we went thousand, but they have the same net assets here at $8,400,000. So they're going to come up with a return here and assets here at 15.43%. So you can see Corp B here has a greater return here on assets versus Corp A here. But now we're going to look further here at Corp A here. And if we look at a return on assets where it uses net income here before interest and after tax. So let's look at that here. So again, we had our net income at $1,296,000. Add back our interest expense here, $240,000. Then we subtract out our tax savings here for this interest at that 40% tax rate. Again, divide that by total assets, total sum here by our total assets, 8,400,000. We're going to come up with that 17.14%. So in this case, Corp A compares with Corp B here at 17.14% for the return here on assets. Now, let's further look at this logic here for Corp A here. We're going to be looking at the return on assets here versus the return on equity here. And it's good to go through this chart here. So we're going to be looking at the rate of return on assets versus the rate of return here on shareholders' equity. And it's going to be for Corp A. And this is the logic here. So we'd set up our little chart here where we have the funds supplied. Again, remember this was for Corp A here. Current liabilities, long-term debt, common stock here, or stockholders' equity here, and then the retained earnings. Total amount here, 8,400,000. Okay, so what we would do is we just take the return on assets, that 17.14% here, times each of those funds supplied here. So you're going to allocate your return on assets for each of the categories here, and that amounts to $1,440,000. You add those up here at that 17.14%. So that is really the income earned on the total assets here. That's what we have for our total assets here. But remember here, we looking at our return on equity. The actual net income they had here was $1,296,000, and we got to that point return here on equity for Corp A. That was simply taking the 15.43% that we originally calculated up here based on their net income here, and then what we would do here, we would subtract out the cost of funds here from the return on assets they had, and that was $144,000. That was that long-term debt here. That was the cost of the funds. And well, how did we get to the $144,000? Let's just go down and look at that. That was simply the 2.4 million here in long-term debt times the 10% interest rate. That was $240,000, and then we have our tax savings. That was simply the 40%, because it's tax deductible here. You take 40% times your interest expense here, subtract that here from your interest expense for the year, and you're going to come up with your actual cost here of borrowing those funds at $144,000. So going back up to our chart here, our cost of funds, we would be subtracting that here from the return on assets here. We're going to come up with, that's the difference here, $411,360 less the cost of funds, $144,000. So our return on equity would be allocated here in that long-term debt at $267,680. So here where we did is just for information purposes here and comparison purposes, we did the return on assets based on our 17.14% here, and then we had to subtract out our cost of funds to come out for return on equity here at 15.43%. So here we got $1,296,000. That was the net income here for Corp A here. That would be the return on equity here, and that's the income earned on the equity here. So here would be the total assets, here's the total equity, and we had to figure in those cost of funds here reduced by the tax on them. Okay, so what are we really talking about here? What are we taking off these calculations here? So what we have here is Corp A borrowed a substantial portion of its assets at a cost here, 10%. And they have used these assets to return in excess of 10%. So, and that represents additional income or income per share here. So the company made more income by borrowing and using borrowing money to buy assets here, and they earned money on those assets here. So the stockholders are happy here. We're going to have a greater income per share here based on the fact that they borrowed these funds here and they've made money on these funds. So they borrowed it at 10%, and then you could either do the comparison here where return on assets either 17.14% or 15.43% return on equity. Either way, they've made money here by borrowing, leveraging out and borrowing money here rather than issuing equity here. They borrowed, Corp A borrowed, made more money here, and by borrowing those funds, they purchased assets, they put those assets to use, and they've earned money on it. Okay, So that's what we want to take away from that here. Okay, so now let's go and let's look at our other rate of returns here. So let's look at the rate of return on shareholders' equity, and that's simply our net income divided by shareholders' equity. And again, we're going to be comparing Corp A and Corp B here. So for Corp B, that would we're talking about that net income here, $1,440,000 divided by the shareholders' equity. And maybe we better go up and look at that here one more time. So shareholders' equity here for Corp B, remember the common stock was $5,800,000 plus retained earnings of $1,400,000. And then for Corp A, equity here in common stock $4 million, and retained earnings the same here at $1,400,000. So those are the numbers we want to look at here and go back down to, that's would be our shareholders' equity. So for Corp B here, we had that $5,800,000 in equity here, plus the retained earnings of $1,400,000. So combining those, divide them into our net income here, we're going to get a rate of return on the shareholders' equity here of 20% here. Rate of return on shareholders' equity here. Now for Corp A here, again, we had our net income here of $1,296,000 divided by our equity here of $4 million plus the retained earnings of $1,400,000, going to give us a 24% return on equity. So you can see here, Corp A is done better than Corp B. They have a 24% here, Corp A, versus 20% here in for Corp B. So return on equity, Corp A does a better job on that. Now let's look at our net income per common stock share here. Again, Corp B here, that net income $1,440,000, and they're going to have 290,000 shares outstanding. So let's go down and first look at how we got those numbers of shares here. So for Corp A here, we had 4 million here in common stock divided by a $20 par amount per share here. We're going to come up with 200 shares. And Corp B, well, we had 5,800,000 divided by a $20 per par value stock. So we're going to come up with 290 shares here. So going back to our net income per common stock share here. Corp B, 1,440,000 in net income divided by that 290,000 shares, or you're going to get $4.96 per share. Corp A here, they only have net income of $1,296,000, but they only have 200,000 shares outstanding, so they're going to get net income per share here at $6.48. So here you can see Corp A is got a better net income per share here because they went out and borrowed money here and they didn't issue as much equity common stock here, so they have less common stock, versus Corp B here where they went out and they issued more common stock and didn't take on the debt here, so they're going to have more shares of common stock here. And then even though Corp B has a greater net income here than Corp A, they still end up with less income per share here because of the math that works out here, the debt versus equity. Corp B doesn't do as good a job here because they only have $4.96 per share, where Corp A here has $6.48 per share. So again, using this debt versus equity, Corp A is going to come out on top here because they have more debt outstanding versus equity here. Okay, and then finally looking at our book value per share of common stock. So Corp B here, that's again, they have their equity here at $5,800,000 plus the retained earnings of $1,400,000. Divide that again by the number of shares that they have outstanding at 290,000. You're going to come up with $24.82 here per share, the book value here, versus Corp A here, they have 4 million here in equity common stock plus the retained earnings of 1,440,000 divided by only 200,000 shares here. They're going to come up with $27 here per share. So you can see here, Corp A, they have less shares or equity outstanding here versus Corp B. They're going to have a greater book value per share here of common stock. And I guess the key here is the book value per share of common stock. That's just in case of a liquidation here. Corp A would be paying out $27 per share here versus Corp B here at $24.82 per share. So again, Corp A takes on the debt, and they have less equity here versus Corp B here, which doesn't take on the debt, and they finance more through equity here, equity shares or equity stock, and they end up with a lower book value per share. Okay, so that just goes through some key numbers here to determine our return on assets here and a return on equities, and how debt financing here works versus equity financing. But this is just an example here to show that in this case where Corp B here had the greater equity, Corp A here had the greater debt, Corp A ends up with a better rate of return here on shareholders' equity, and also net income here per share because they have less shares outstanding, and also they come up with a better book value here per share, book value per share in case of a liquidation. And then we went through the rate of return here on assets here. Both of them ended up at about the same percentage, depending on how you looked at it, either net income before interest or after tax or just plain net income. All right, so that summarizes our discussion here on comparing debt versus equity financing for looking at the return on assets and a return on equity. Okay, that summarizes it.